Refinancing is a topic that, for the last few years, felt as though it had simply vanished from our collective financial conversation. We lived through a period where interest rates moved so sharply and so aggressively against borrowers that the very notion of replacing an existing mortgage felt like a relic of a different era. But as we move through the early months of 2026, I am starting to hear this question surface once again in my consultations and in our community. Clara, is it finally time to look at refinancing? It is a question born of a very specific economic reality. Today's mortgage rates are undeniably meaningfully lower than the peaks we witnessed throughout late 2022 and 2023, a time when we saw rates briefly touch 7% and even flirt with the 8% mark. We are no longer in that high pressure environment. Yet, we must also acknowledge that we aren't exactly back in the world of ultra low pandemic rates either. We find ourselves in a middle ground. And while the middle ground can feel uncertain, it is actually the perfect environment for a calm, strategic analysis. If you are a homeowner who bought during those peak years, you might feel a sense of urgency to fix your monthly payment. My goal today isn't to tell you to rush, but rather to help you ground your decision in math and long-term stability. Let's take a breath and look at whether the current landscape offers a genuine opportunity for your retirement security, or if the best move for you is actually to stay exactly where you are. To make a wise decision, we have to start with the data. As we sit here in late February 2026, the national averages have settled into a new rhythm. For a 30-year fixed-rate mortgage, we are seeing rates hover around 6%. If you were looking at a 15-year fixed-rate mortgage, that number drops slightly to the 5.4 to 5.5% range. Now, I wouldn't go so far as to call these cheap in a historical context, but they represent a significant relief valve compared to the recent past. To understand why people are talking about this again, we have to zoom out and look at the trajectory of the last 5 years. In 2021, we saw those historic pandemic lows of roughly 2.7% to 3.1%. Then came 2022, a year defined by spiking inflation and a Federal Reserve that moved with unprecedented speed to tighten the economy. By late 2022 and through 2023, rates peaked in that painful 7.5 to 7.8% range. The following 2 years, 2024 and 2025, were characterized by choppy movement, mostly staying between 6.3 and 7%. Now, in early 2026, we have drifted back towards 6%. It's important to remember that these are just averages. In the real world, your specific profile matters more than the headline. If you have an exceptional credit score and you're working with a lender with a lean fee structure, you might see offers around 5.7 or 5.9%. If you are willing to pay points, prepaying interest to lower your rate, you might even see the mid fives. Alternatively, choosing a 15-year term can often shave another 0.5 to 0.7% off your rate, though, of course, that comes with the trade-off of a higher monthly obligation. The real question we have to answer today isn't just, are rates lower? We know they are. The question is the improvement meaningful enough for your specific household once the costs of the transition are factored in? Before we dive into those calculations, we need to manage our expectations regarding the Federal Reserve. I know many of you are waiting. You're waiting for that next Fed meeting, waiting for the big rate cut, waiting for the floor to drop out so rates return to the 3% range. But based on the Fed's own projections from late 2025, policymakers are only anticipating one rate cut in 2026. If that happens, it would bring the federal funds rate into the low 3% range, roughly 3.25 to 3.5% by year end. As of right now, the Fed hasn't moved. They're in a wait-and-watch posture, observing the economic data. This tells us they are in no rush. While inflation has cooled, it isn't fully extinguished, and the labor market remains surprisingly resilient. Most economists fall into a few camps. Some expect one or two modest cuts as growth slows. Others believe the Fed will hold steady all year if inflation stays sticky. And a smaller group warns that if prices move up again, we might not see any cuts at all. This leads to a vital distinction. Fed rate cuts do not automatically equal lower mortgage rates. This is perhaps the most misunderstood concept in home finance. The Fed controls the short-term cost of money, the thermostat, if you will, for right now. But mortgage rates are the climate. They are set by the bond market, and they reflect where the investors believe the economy is headed over the next decade or two. Mortgage rates are driven by 10-year Treasury yields, inflation expectations, and the risk premium lenders demand for tying up their money for 30 years. This is why you'll often see mortgage rates move down before the Fed actually cuts, or sometimes not move at all when a cut is announced. The market prices in the future. Right now, the bond market is telling us that while a gradual decline is possible, a dramatic collapse in rates is not currently on the horizon. When we think about whether to pull the trigger on a refinance, we have to look past the interest rate and look at the why. Refinancing is a tool that should improve your life in one of 5 very specific ways. Consider the story of a couple I'll call David and Susan. They bought their forever home in early 2023 when rates were near 7.6%. For them, the primary goal was lowering the interest rate to improve their monthly cash flow. By refinancing at today's 6% rate, they could save hundreds of dollars every month. However, they had to do a break-even analysis. They weren't just looking at the new payment, they were looking at the $6,000 in closing costs they had to pay to get that new rate. Then there's the goal of shortening the loan term. Perhaps you're 60 years old and you have a 30-year mortgage. The idea of carrying a house payment until you're 90 might feel unsettling. Moving from a 30-year to a 15-year mortgage might not lower your monthly payment. In fact, it will likely increase it, but it dramatically reduces the total interest paid and accelerates your path to true debt freedom. Another common scenario involves private mortgage insurance, or PMI. If you purchased your home with less than 20% down, you are likely paying a monthly fee that protects the lender, not you. If your home has appreciated in value over the last 2 years, a refinance could allow you to wipe that PMI away entirely. Note, however, that if you have a conventional loan, you might not even need to refinance to do this. You might simply need to reach out to your lender once your equity hits that 20% threshold. We also see cash-out refinances, often used for major home renovations or debt restructuring. I want to offer a word of professional caution here. At this stage of life, I am a firm believer in the peace that comes from being debt-free. Re-leveraging your home, essentially taking on more debt against your primary shelter, is something I rarely recommend unless it is part of a very specific, high-level strategic plan. Finally, there is the goal of improving predictability. If you are currently in an adjustable rate mortgage, or ARM, and you're nervous about where your payment might be in 2 years, moving to a fixed rate is about buying peace of mind. In retirement, knowing exactly what your largest expense will be for the next 2 decades is a form of financial insurance that is hard to put a price on. So, how do we decide if the math works for you? You've likely heard the old rule of thumb, only refinance if you can drop your rate by 1%. While that's a helpful back-of-the-napkin starting point, we need to be more precise. Step 1. Calculate your potential monthly savings. Let's use a concrete example. Imagine you have a $300,000 mortgage at 7.5%. Your monthly principal and interest payment is roughly $2,100. If you can refinance that same $300,000 at 6.5%, your new payment drops to just under $1,900. That is a monthly savings of $200. Step 2. Determine your total closing costs. Refinancing isn't free. You have appraisals, title insurance, and lender fees. Let's assume those costs total $6,000 for this loan. Step 3. Find your break-even point. Take your total closing costs and divide them by your monthly savings. $6,000 divided by $200 equals 30 months. This means it will take you 2.5 years of making the new, lower payment just to get back to zero. If you plan on staying in your home for 10 years, this refinance is a brilliant move. If you think you might downsize or move closer to family in the next 2 years, you would actually lose money by refinancing. Step 4. Consider the reset factor. When you refinance, you are often resetting the 30-year clock. If you've already paid 5 years into your current mortgage and you take out a new 30-year loan, you are extending your debt obligation. A strategic way to handle this is to refinance to the lower rate but continue making your old, higher payment. This allows the interest savings to go directly toward your principal, significantly shortening the life of the loan. Step 5. Assess your current asset status. If you are one of the fortunate homeowners sitting on a mortgage rate below 4%, your mortgage is no longer just a debt, it's an asset. In an environment where you can earn 5% in a high-yield savings account or a CD, your 3% mortgage is cheap money. In this case, there is absolutely no mathematical reason to refinance. You're better off keeping that low-interest debt and letting your extra cash earn a higher return elsewhere. A common fear I hear is the feeling of having missed out. Many people who bought in 2023 feel they made a mistake because they bought at the top of the rate cycle. I want to reframe that for you. You didn't make a mistake, you made a life decision. You bought shelter, stability, and a place for your family to gather. A mortgage is not a permanent sentence, it is a bridge. Most homeowners refinance at least once, and many do it multiple times over the course of 30 years. Your 7.5 rate was simply the bridge that allowed you to own your home during that chapter of your life. Another misconception is that rolling the costs into the loan makes the refinance free. It does not. It simply means you are paying interest on your closing costs for the next 30 years. It might help your immediate cash flow because you don't have to write a check today, but it increases the total interest burden of the loan. Always look at the total cost, not just the out-of-pocket cost. Finally, don't fall into the trap of rate-watching fatigue. Constantly checking the daily fluctuations of the bond market can create a sense of low-level anxiety. It makes you feel like you're always a day late or about to miss a window. Shift your mindset. You don't need the perfect rate. You just need a rate that is good enough to satisfy your break-even math and improve your long-term security. If the math doesn't quite pencil out for a refinance today, don't feel like you are stuck in neutral. There are powerful actions you can take right now to improve your position while you wait for the market to shift. The most effective tool at your disposal is the targeted principal payment. Because mortgage interest is front-loaded, meaning you pay more interest in the early years of the loan, even a small extra payment made now has a massive impact. Adding an extra $100 or $200 to your principal each month reduces the balance that future interest is calculated on. This puts you in a much stronger equity position for whenever you do decide to refinance. Another hidden gem in the banking world is the mortgage recast. This is one of the most underutilized strategies in personal finance. In a recast, you don't get a new loan or a new interest rate. Instead, you make a large lump sum payment toward your principal, perhaps from a home sale, an inheritance, or a bonus, and ask the lender to re-amortize your remaining balance. The lender will recalculate your monthly payment based on the new, lower balance, but your interest rate stays the same. The cost is usually just a few $100s in administrative fees, rather than the thousands required for a refinance. It doesn't require a new credit check or a full appraisal. While lenders rarely advertise this because it doesn't generate high fees for them, most conventional lenders offer it if you simply ask. Imagine you have a $400,000 mortgage at 7%. 2 years in, you decide to put $50,000 toward the principal. If you recast, your monthly payment might drop from $2,600 to $2,000. That's $600 a month back in your pocket without the hassle of a full refinance. Lastly, use this time to polish your borrower profile, credit score. A 20 to 40 point increase can move you into a different tier for lenders, resulting in lower fees. Debt to income ratio. Focus on paying down revolving debt like credit cards. Equity. Every extra dollar you pay toward the house increases your equity position, which gives you more leverage when you eventually walk into a lender's office. Think of this as a period of intentional preparation. You aren't waiting on the sidelines, you are warming up so that when the door opens, you can walk through it with total confidence. Deciding whether to refinance is rarely about beating the market. It's about understanding your own numbers and making a choice that aligns with the life you want to live in retirement. We don't win this game by guessing where the Fed will be in 6 months. We win by knowing our break-even point, maintaining a strong financial profile, and acting when the math clearly serves our goals. Whether that move for you is a refinance today, a mortgage recast tomorrow, or simply staying the course with extra principal payments, remember that you are in the driver's seat. Financial peace isn't found in a specific interest rate, it's found in the clarity of your plan. Take a moment this week to look at your latest mortgage statement. Find your current rate, your remaining balance, and your years left. Once you have those numbers, you can stop wondering and start knowing. If you found this perspective helpful, I would be so grateful if you would share this video with a friend who might be navigating these same questions. It's through these thoughtful conversations that we all build a more secure future. And if you're new to our community, I invite you to subscribe. We explore these kinds of strategic retirement topics every single week. I'd love to hear from you in the comments below. If you bought a home recently, what is the target rate that would make a refinance worth it for you? I'll be down there responding to as many of you as I can. Until next time, I'm Clara Morgan. Take care of your money and take care of yourself.